Yeah, so just a very short introduction. This is the second in our lecture in our three-part series on finance and monetary economics. Well, without further ado, Jens will be talking about the secret world of monetary policy implementation.
Okay, thank you. Today I'm going to be talking about money, basically. So monetary policy implementation is the use of the interest rate by the setting of the interest rate by central banks through operations on money markets. And I think looking at monetary policy implementation gives you a really different understanding of what money is than you would usually have. And for today I thought one interesting way to bring that out is to argue that money is best understood as a fictitious commodity. So in previous lectures here, people have argued similar things for labor and land. Namely that they are fictitious commodity and that they are traded on markets where there are some interactions of supply and demand, but that in actual fact we think that their distribution allocation are so important that we don't want supply and demand to steer that completely, and therefore in fact have a far broader range of institutional conditions in which that allocation happens, but that there is a strong emphasis on this commodity aspect, in part for ideological reasons, right? So there are strong distributive, conflictual dimensions of these institutions, and focusing on its commodity aspect de-emphasizes these conflictual dimensions. So Polanyi, who introduced the idea of a fictitious commodity, has actually made this claim in precisely this way, that just like labor and land, money too is a fictitious commodity. As he argues, money is merely a token of purchasing power, which as a rule is not produced at all, but comes into being through the mechanisms of banking or state finance. The commodity description of money is entirely fictitious. And I will bring this out by showing that to have a means of payment, citizens keep their money in bank accounts, and banks in turn have their own money on accounts at the central bank. And rather than thinking of this as a commodity, as a good that's fixed and that's somehow subject to scarcity and supply and demand, I think it's important to look at monetary policy implementation, where you see that to maintain the system, banks trade central bank money on money markets under very close hour-to-hour scrutiny of central bank monetary authorities. Okay, so first I will look at quantity conceptions of money and the danger of inflation. Then I will talk about, I think, a more convincing way to think of money, namely credit theory, and the consequences of the credit theory for the amount of money that's available in the economy. And then I will look at the role of central banks in this story and see how the changes to finance after the financial crisis bring out this aspect of a fictitious commodity even more than the earlier situation, which I in fact focus on in this talk. So quantity theory, I hope this should be roughly familiar to most people after 1 or 2 years of economics studies, right? So the idea is you have a fixed amount of money, for example, 10 notes of 10 euros, and you have a velocity, so an amount of time that a given note is used, right? For example, 10 times. Now, given that you know that, you will know the range of prices and goods that are going to be possible, and specifically if you also know the amount of transactions, for example, that there are 100 goods that are traded, then you know that the prices at which they are going to be exchanged are exactly fixed by the amount of money that is available. Now, there are two. This by itself is an identity, right? So it says nothing about the world. It's a way of defining concepts. But I think there are two rough ways to look at it, which I will bring out, right? So there's quantity theory of money, which really tries to get an explanation of prices from this identity. And then there is a more endogenous account in which these concepts are in general recognized, but there is a much more complex relation between money and prices than suggested by the quantity theory. So for the quantity theory, money is a scarce good. Available amount is set exogenously, right? It's already given, and then the economic process starts. So it used to be gold mining, right? There was just that much gold, and that determined prices. And now it's the central bank policy. And then quantity theory assumes that the velocity of money is fixed and the quantity is fixed. And then you know what the prices are going to be given the amount of money is there. And if you increase the amount of money too much, right, if the central bank would do that, then you have too much money chasing too few goods, as Friedman said it, and you get inflation. So in principle, I have a very short video that brings this story out by the European Central Bank. So this is a man, and he has just increased his price, and this is the and they're wondering why do these prices increase, right? And at this point, this being appears in the story, and he just gives money to this boy, and then of course he's going to spend it, right? But then the prices increase again, right? He's upset. Oh, what's happening? And then she's very sad, right? Oh, we'll never be able to buy anything if this continues.
Can you say the name of this being?
And now inflation comes again, right? Inflation, the blue monster. You just need more money. Wait, and now I know you. You are inflation. Okay, well, and then society breaks down, right? Okay. Okay, so that's the quantity story, right? And this also has a very clear policy implication, right? Central banks should do nothing, right? They should allow the amount of money to grow very steadily, and then the free markets will do their magic in setting the prices as close to their efficient prices. Okay, so now I'm just going to move to a completely different story, right? I think bringing in this story will provide reasons to see that certain aspects of this story may be true, but it's just a very misleading way to think about the nature of money more generally. And that's the credit theory of money. So according to the credit theory, money is primarily a social standard, right? It's a way to keep account of who owes what to whom. And in this perspective, it's not primarily a commodity, but a relation between a debtor and a creditor. And the best way to see that is by stylized balance sheets. So stylized balance sheets are a way to represent these credit relations, right? So this is one. So here you have a bank, and the bank owns things. Those are things that the bank has, or that other economic entities owe to the bank. And there are liabilities, right? Things that other economic entities owe to the bank. And here, firm, it's the converse. So here you have one simple representation of a loan, right? The firm has a liability, it owes a loan to a bank, and the bank has a loan, right? So it's going to be paid by get money back from the firm at some point. And at this point we completely abstract from interest rates, right? And I'm going to use this mode of representation to look at money. Now, okay, what's money, right? We know it has three different roles. It's a means of payment, it's a unit of account, and a store of value. And I think if you use this criterion, then in today's world, 98% of money in circulation is bank money, right? It's the money that people have on their bank accounts and they use to make payments. So how to represent this? Well, you have a bank. The bank has a liability to a household, right? It owes money to the household. And the household has a deposit, right? It's an asset of the household that it can dispose over and use to make payments or pay debts. So credit money is debt issued by commercial bank in the form of customer deposits. And I think a credit theory might lead to saying this is a credit theory can lead to overcomplicating it, right? So it's the keeping of accounts between creditor and debtor that's crucial. It's not crucial that there's going to be repayment, right? It's not the idea that, you know, in a year from now, this money has to come back, but it expresses the relations as they exist. I think this way of representing is very important for understanding current economy. And I think this comes very nicely in a paper by Dirk Bezemer called "No One Saw This Coming," and he investigates. So were there economists who warned for the financial crisis, and if so, what were their methodology? As he brings out, all people who had really substantial predictions, right? Like before 2010, this debt bubble is gonna burst, and there's going to be a big recession. All these people, in some way or another, used an accounting model for understanding the financial sector rather than an equilibrium model, and had this relational conception of debt and finance rather than the idea that it's something that one unit owes to has. Okay, so how do you make a payment with a debt, right? I think that's not yet completely clear at this point. So imagine a shop, right? And the shop, there's a household and it's buying a car. So as you saw, right, it has an asset and it moves to the household. Now the household has to make a payment. Imagine in this case they both have an account at the same bank. What will happen is that the household's going to ask the bank to transfer money to the account of the shop, right? So the shop gets a new asset, the deposit, and the deposit of the household is destroyed, and what remains is a larger deposit of the shop, right? So this is how you use debts to make payments. And I think from this perspective, every economic transaction has three elements. So there's a creation of an implicit contract between buyer and the seller, there's a transfer of good to a buyer, and then thirdly, most importantly, there is payments by means of a debt issued by a trustworthy third party and settlement of the economic transaction on the balance sheet of this third party, right? So where it happens is here, right? It's this change which makes the payment. So how does money come into being? Well, the most simple way to look at it is just imagine the case where the household would sell the car to the bank, right? So the bank would get the auto and it would give a deposit to the household, right? Bang, you have created money. There. Then I think a more realistic case is that, and more representative, is that it happens to credit provision, right? So in creating a loan to a firm, right, the bank creates a deposit. It says you have now a million euros. Firm gets that as an asset. The bank has that as a liability, and the bank at the same time gets a 1-year loan, right? So it doesn't lose money. It just has a different kind of asset, and the firm has a liability, something which it owes to the bank. And in this act, you have created money through credit provision. Well, if this is how money is created and functions, there is no fixed end, right? So banks create money in the course of their everyday functioning, and if prices rise, people will need more money. They will take out larger denominated loans, and thereby, the amount of money in circulation increases. Well, on this account, there is no strict limit to M. That doesn't mean that people can just create money whatever they want, right? So banks have a risk of default whenever they issue a loan, and as we'll see, they have also funding questions, right? They have to fund themselves, and for customers, taking out money has a price, right? If you're just going to take out random loans and repay them in a year, you have to pay the interest on that during that period. So they will try to limit the amount of money that they have to what they actually need for a transaction. Yeah, is that so far clear? Yeah. Okay, so where does the central bank come in, right? At this point, there is no central bank in the story. We have payments, we have what appears to all purposes a functioning payment system, and no central bank. Well, one reason for that is that we've looked at a situation where there is only one bank, right? But I think there's a deeper reason. So I think first it's important to consider the bank more generally. What is a bank? And I think that comes out best in the so-called 363 model of banking, right? So this is a bank, right? It has assets with a long maturity. It lends out money for a longer period, right? To corporations and, okay, to mortgages, right? That's what they in reality do. And then you have the deposits of households. And importantly, deposits have a very short maturity, right? You can take them out tomorrow, right? You can just take all your money from the bank, make payments with it. This fluctuates wildly. At the same time, these long maturities, they're fixed, right? If banks would suddenly decide to sell their whole mortgage portfolio, then that's gonna, that's not gonna be worth as much as if they just keep them here, right? So banks are inherently unstable, right? They have very long maturity loans and very short maturity liabilities. This model is called 363 banking because you lend the money for 3%, you lend it out for 6%, and you go to the golf course at 3 o'clock. Well, banking has become a bit more complicated, but I think this model of what a bank is still exists. Okay, so now we're going to move to the other side of the story we just saw of the household buying a car. And we're going to look at the case where actually these two economic units have different banks, right? So they are going to make a payment to each other, although they have their money at different banks. So here you have the bank of the household that makes the payment, right? It has to pay for the car. And here you have the bank of the car shop, right? This receives the payment. And importantly, to do that, it's going to create a deposit, right? So this deposit is going to disappear, and this deposit is going to appear. And banks are going to have to pay each other for this through settlement at the central bank. So to make payments to each other, central banks have their own bank account at the central bank. So this is the deposit of the household, and this is the deposit of the car shop. Now, banks try to keep the amount on their deposit at the exact reserve requirement. So they try to keep that as stable as possible. In some countries, that means just zero, right? They have nothing there. In the Eurozone, they have to keep a certain percentage. But important for them is that they keep it stable. I'll get back to that. So what's going to happen then is that the household bank is going to ask the central bank to create money for the bank of the car shop, right? So the central bank is going to create a deposit for the bank of the car shop, and that pays for the deposit created. At that point, the household bank has a negative deposit, right? It's an overdraft, and the bank household, a bank of household would have to pay interest on that, and that's how, at least for our purposes, this first transaction is settled, right? And I think this idea of central bank money is really crucial also to commodity theories in their current status, right? So, for example, Friedman. So he focuses very much on this central bank money, right? M0. So bank used that to make payments, right? And it also serves on his theory as a limitation to how much they can lend out to customers. And for that reason it's called high-powered money. But I don't think that's the right way to look at these deposits. I think they are really meant to make payments, and they are also, by all accounts of current central banks, not used to limit or expand lending by central banks. So what do they do, right? So now we have just a situation where the first bank has an overdraft and the second bank has excess reserves, right? At that point, it becomes important to look at the interest rates. At this point, the prices of money become very important. So the bank has an overdraft, and for that reason, it needs to either pay a very high interest rate, or it needs, more realistically, to borrow money somehow to make up for its deficit. And at the same time, Bank 2 has excess reserves. Now, on excess reserves, you don't get paid interest or very little, so it's incentivized to lend out that money, right? And the way in which this demand and supply are connected is through the overnight money market. So at the end of the day, banks take all these liquidity needs and they call each other up. You have money? No. And then they lend it to each other for a period of one day, and then there are larger fluctuations. They will try to get longer loans, right? But importantly, the sort of payments we just saw are not the only source of fluctuation. So banks have way more fluctuation. To understand that, it's important again to look at the central bank. Because the central bank is not only in the business of settling payments between banks, it's also in the business of issuing banknotes, right? So it's possible that customers take out money from the banks, and then the bank has to give out that money to its customers in paper form. It's also possible, there's also the government account, right? So if you pay to the government, that's also settled at the central bank. There are also foreign claims, right? If you pay money abroad, then the central bank goes to its central bank and makes payment there. And then there's central bank money. So as a consequence, the amount of central bank money that's available fluctuates very much. So it not only fluctuates on the accounts of individual banks, it also fluctuates with regard to how much is available in the economic system as a whole. And that means that both its supply and its demand are very unstable, right? So banks might either have to make all sorts of payments to other parts of the central bank balance sheet, or they receive a lot of payments and then they have way too much money as a whole. Now, to address this problem, the central bank has to do something, right? If you would, at this point, leave interest rates completely to supply and demand, then you would just get wildly fluctuating prices. Banks need that money to settle, right? The quantity would be fixed. You would get very large fluctuations in the interest rates, right? So quantities change. You have very inflexible demand and supply curves. You could just get all sorts of prices, either at 0% or extremely high interest rates. So to prevent that, central banks have two main roles in money markets. So on one hand, they function as dealers, in the sense that they're always willing to buy and sell deposits at a certain premium, and they function as suppliers. So they try to adapt these fluctuations in the money supply through the day, through the week, through the season. They try to predict that with econometric models, and then adapt their position of money to the exact needs of the financial system. Or, well, at least that's what they did till 2008, and now they are in a situation where these demands are perceived to be so much fluctuating that they allow banks to basically tell them, you know, how much money do you want? Okay, here it is. So that results in a money market of the following shape. So this is the European situation. You have interest rates, which the central bank decides on, and then you have the monetary policy implementation. So you have the target interest rate, and then you have the spread that the central bank offers on that. So it's always ready to lend out at a slightly higher interest rate, and always ready to borrow at slightly lower interest rate. And then by also trying to keep the supply stable, the actual interest rate that banks charge to each other is regulated very strongly. So this is the gray line you see that fluctuates within the bands set by the central bank, but not outside. And then of course 2008 happened and it was briefly chaos, but we recovered. Yeah, so before 2000, so now to briefly expand on what happened, right? Before 2008 was the idea that if you just keep the overnight interest rate stable, then all other loans are going to be calculated by a markup, and so you get the yield curve, right? To longer maturity, a higher interest rate. These are the interest rates, and banks get their money at the cheapest in the overnight market, and then the efficient market takes off from there. And this of course is very much premised on a conception of efficient markets. Now, since the crisis, central banks around the world have become much more involved in stabilizing prices everywhere, right? So they no longer believe that these prices reflect the price at which you will have the most efficient allocation of goods. Rather, they're intervening in all sorts of markets to create a price which they believe will lead to a more efficient allocation. So, for example, just for the European central banks, you have loans in the long-term refinance operation, so lending banks money for a longer period, right? So previously it was expected that banks would do that to each other. Now the central bank is doing that. There's the emergency liquidity assistance, right? What's happening in Greece now? Just getting money immediately if you threaten to go bankrupt, although you're still solvent and possibly not even that. Then there are the all intervention sovereign bond markets, right? There's also no longer the belief that the prices in the sovereign bonds market really accurately reflect their best prices. And now there is Euro QE. Now QE is also an instance of really intervening in prices because on financial markets, because you don't believe that they lead to the most efficient allocations. And in doing that, central banks really make choices in where the money goes, right? So the Bank of England has also presented all these numbers for its QE program. That has huge distributive consequences, right? So as soon as you're going to make decisions on prices in markets, you're going to affect, what things are worth and who owes what to whom. So to summarize, what I've argued, right? So money is not a commodity, but it's better understood as a credit relation between economic units. Without constant regulation, banks and firms would be unable to meet their requirements, right? So there's this whole system to banks, to central banks, in which there is money available so that people can make their payments at the right moment, and the economy continues to function. And in this sense, it's a fictitious commodity, right? We don't think we should leave the provision of money to supply and demand forces. Rather, we think it should be available because we don't accept the social consequences if money was really left to the market. And again, this is, as Polanyi puts it, The market administration of purchasing power, in this case, would periodically liquidate business enterprises for shortages in surface of money, would prove as disastrous to businesses as floods and droughts in primitive society. No society could stand the effects of such a system of crude fictions, even for the shortest stretch of time, unless human and natural substances, as well as business organization, was protected against the ravages of the satanic milk. Now, as I hope to have shown, the 2008 crisis brought this out even more. Right? Without stabilizing the central bank, you would have had, like, you know, complete breakdown of the whole ability of anyone to pay anything. And I think the best way to look at that is not as an exception to the rule, but rather how money has always functioned. Right? Even in the 19th century, with the gold standards, central banks were actively involved in monetary policy, setting interest rates and maintaining the stable value of money, rather than letting the quantity of gold that was actually available in a country determine the prices. Yeah, and so briefly, if you are now really interested in these topics, so there's a fantastic online course on Coursera by Perry Merlin called Economics of Money and Banking, and it you know, it looks way more detail at all the institutions involved in the financial sector, and I think this is really a crucial component in a good understanding of the existing economic institutions which we deal with. Okay, thank you very much. Yeah, so if there are any questions, then I would be happy to answer those. Ivan.
So banks create money every time they give a loan to a customer, and commercial banks themselves have money at their accounts at the central bank, and this money that they have at their accounts at the central bank is central bank money, which is created then by the central bank, which then also creates cash. So essentially, all money that's around in a modern monetary system can be created at will by the actors. Well, by the monetary actors, monetary institutions. So what's there to prevent us from solving any problem in the money sphere by simply creating or destroying money and distributing it in a way that would solve well, basically any crisis with liquidity or solvency or whatever?
Yeah, so I think this is a very timely question, right? So there's a lot of discussions on radically different ways of organizing banking and money, right? And specifically a more political role in money creation. So in my own research, I'm at the philosophy faculty. I also very much look at moral questions related to financial markets and responsibilities of different economic agents in this context. So I'm very interested in this question, and I'm also open to all sorts of suggestions, but maybe it's good to consider some reasons why you would not want to do that. Right? So indeed, the central bank has these all these different numbers on its balance sheet, and it can just, in principle, change them with one, you know, key press. So first off, there are international obligations, right? So you have obligations to other countries, and they will be very upset if you're going to say they don't exist anymore. But I think what's more important is that the central bank is not a political institution, right? So it doesn't have that structure at all, and it's also not particularly attractive to combine both this function and a political function in one institution. So on any account, we'll be talking about a very different economic system. Now, I think one reason you might not want to do this with the central bank, rather than, is that these are very political questions, very difficult, right? You would just randomly allocating money in different ways. And we have a system for that, right? We have a parliament which decides on government expenditures and on taxation. So if you would really want to reallocate substantially the possessions of people within the economy, you could just do taxation and spending in a roughly similar way. And there you would have, of course, all sorts of political problems, right? There would be people in parliament being against it, being in favor of that. But, I mean, that also serves a function, right? It checks and it balances really crazy ideas. And I think a more promising way to go would in principle be to have parliamentary democracy function better, have the taxation system function much better. And then I am not sure if you would still really need particularly activist central bank policy to address social problems. Sorry, Jörg.
This leads on really to that question. Right at the end there, you said that the Bank of England, in its quantitative easing, had made essentially a very political decision about where to allocate that money. Yeah. And you said that had all sorts of effects on who owed what to whom or something. Could you just explain where that money went, and could you suggest some possible alternatives as to where it might have gone?
Where it went? Yeah. Well, I mean, just the central bank. So I would be. So I'll avoid spelling out the whole details in this specific way of what QE consists in, right? But I think the important thing is that the central bank buys assets, right? It intervenes in a market for that asset, increases the prices, and thereby seeks to achieve all sorts of economic goals. It's trying to do that in a way that leaves at least a large part of allocation still to financial markets, right? So it increases or decreases prices, but then how economic agents decide to act on that is up to them still, right?
So my question really was how could it have otherwise been allocated, which might have been more just or more efficient?
Well, so as I was arguing just now, what I think so if you would want to do something really radical, right? Okay, you could always just start printing money, handing out 4,000 euros to every citizen of the Eurozone. And maybe in the current situation that would just be a great thing to do, right? Maybe it would be a solution to certain problems, and people have argued that. But yeah, my question at that point is just, if that's really what you want to do, right? You're going to make other people who already own money, less well off probably, and you're just distributing. And if that's what you want to do, why don't you just tax it and then give it out to people in the normal way rather than using a central bank for that?
I was wondering, because in the model you show about the T accounts, I don't know exactly where the money is created, because when you show the examples, every time an asset is created, a deposit is created. Yeah. So always is some zero. Yeah. The only two that can be justified that are creating money is the central bank, because you never said that he should balance in another place, or entities outside the market. So my point is, the midway, like middle banks and all the other monetary institutions, they are always adding zeros. So I don't know where the money is created in that process. Once again, I understand central bank, I understand outside, but in that process, I don't see where the money appears.
Okay. I'll go into it. And the person behind you, and I'll take both questions.
Yes, I want to comment on the fact that your title is The Secret World of Monetary Policy Implementation. And You talked about taxation as a kind of a political means of introducing some kind of fairness into the system, but if the system is so rotten, commercial banks make billions of pounds of profit on the backs of ordinary citizens. And you haven't talked about the profit mechanism in relation to the central bank, so if you have any comments about that. And also in terms of the secrecy, who's on the board of these central banks? Who are they? Who are the people that actually run a monetary system, advise governments on monetary systems, and keep in place a very unjust and very unequal distribution of wealth and income in society?
Yeah, so I think these are fair concerns, of course, or I think that. So indeed, I think this is a very fair point, and maybe it also relates to your question, right? So why do we give commercial banks this authority to just be creating deposits and creating loans, and why not have a completely different authority deciding on that, right? And this is more or less a question about the legitimacy of commercial banks rather than a question about the legitimacy of central banks. Now, so I think this is standardly motivated by the idea of efficient markets, right? That banks are going to be, they follow price incentives, are going to be best able to allocate money and just thereby coordinate investment in the economy. So this is an empirical question whether it's actually true. It's also a counterfactual theory, right? We don't have an economic system in which things are organized radically different. But I think that would primarily be the way to justify it, and also the way to criticize it is to bring out ways in which this is not the most efficient way to allocate resources. But yeah, to return to the earlier question, because that is in fact what's happening, right? You just have banks giving out money, having this authority to decide on what they think are going to be profitable investments, and then a large part of what happens in our economy is determined by whether an individual at a given bank thinks this is a profitable thing to do. And we know increasingly from empirical science that people are subject to all sorts of biases, right? They do just do random things basically, and particularly there are just great difficulties in at the same time in a very uncertain situation trying to make decisions about what a project is going to bring in money in 10 years from now, and at the same time fairness, right? Giving people an equal opportunity to initiate economic activities, and yeah, I think that's important. Well, doubt you could have, and more generally you could think that rather than profit, more social and ecological aims should be crucial to how you organize the bank system. And then you would be thinking more about like a state-owned investment bank, such as Natalia argued for last week.
Sorry to recall, still I don't see where the money is created.
Yeah.
In the sense that when they decide to whom to give the money, either it's because they already have the money or they ask it from the central bank. So still they have some zero gain. So once again, I don't see how. Yeah,
so my argument is that that's not the case, right? They don't get it from the central bank. They just issue it, and then they will need to get money when they make a payment, right? So at first it's just there, and then make a payment. And then the monetarist would argue that this amount of bank money is limited.
Exactly.
Right?
So it's kind of
yeah. So okay. So the monetarist would argue this is limited, right? This is fixed, or it should be fixed, right? So it turned out it wasn't fixed. So then they started arguing it should be fixed. It was a completely different theory by that point, but you know. I think the dynamics that I showed point out why you can't do that, right? The liquidity amounts fluctuate to such extent that if you would actually allow banks to, if you would limit them to the amount of deposits given, you would have these extreme fluctuations, and you saw that. So early 80s, they experimented with quasi-form of monetarist policy implementation, and you had these insane spikes of interest rates, and everybody thought it was a disaster. So rather than keeping this amount fixed, central banks adapt their supply of money throughout the business cycle and thereby lose this ability to limit credit creation by commercial banks by means of the deposits that they make available, right? That the supply of deposits be determined by the economic system and thereby lose, or they never had it, right? But they, because they set, so very simply, right? Because they set the price, they lose control over the quantity.
But in that case,
I think we have to finish, but I'm sure Jens will be happy to stay for more questions. But we actually have to leave now. We have
okay.
occasional problems.
Thank you very much for your attention.